Let me tell you about a guy named Terry. Terry worked as a high school gym teacher in Ohio. He drove a 12-year-old Toyota Camry. He packed his lunch every day. He didn't have a financial advisor, he didn't have a trust fund, and the closest thing he had to an investment strategy was a savings account at his local credit union earning 0.4% interest. In 2009, Terry put $14,000, basically his entire emergency fund, into the stock market. Not because he was smart, not because he had inside information, but because he saw a pattern. A pattern that history had shown him twice before meant one thing. An extraordinary window of opportunity was open. By 2017, Terry's $14,000 had turned into just over $110,000. Terry is not a genius. Terry is not a Wall Street insider. Terry is proof of what happens when ordinary people recognize a specific moment in financial history and act on it. That moment? It's happening again, right now. And if you stay with me for the next 20 minutes, I'm going to show you exactly what it looks like, why it works, and how regular people like Terry, have used it to completely change their financial lives. My name is Mike. I've been in finance for over 25 years. I've seen bull markets and bear markets. I've watched bubbles inflate and explode. And I've watched a handful of very specific moments that occur maybe 3 or 4 times in a generation, produce more millionaires from the middle class than any other event in modern economic history. We're standing in one of those moments right now.
Okay, so what exactly is this pattern? I call it the fear-wealth inversion. Here's what that means in plain English. Every so often, and I mean every decade or so, you get a period where fear and uncertainty are so high that most people pull their money out of the market, out of investments, out of anything that feels risky. They park their cash in mattresses, in savings accounts, in treasury bills. They wait, they hold, they don't want to lose what they have. And here's the brutal irony of that behavior. It is precisely that moment, the moment of maximum fear, that history shows is the most powerful time to build wealth. Why? Because when fear peaks, prices collapse. Assets that were worth $10 are now worth $3. Great companies are being sold at garage sale prices. Real estate, stocks, commodities, they all get hit. And here's the thing about prices that have dropped 50, 60, 70%. They have a very long way to go back up. The people who understand this, the people who can stomach the fear, who see past the noise and the headlines, who recognize the pattern, those are the people who come out the other side completely transformed. Now, I need you to understand something important before we go any further. This is not about timing the market perfectly. It is not about predicting exactly when the bottom is. The great investor Peter Lynch once said something that has stuck with me my entire career. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. What this is about is recognizing a window that history shows us opens, stays open for a period of time, sometimes months, sometimes a couple of years, and then closes. And when it closes, the people who were inside are sitting on extraordinary gains, and the people who were standing outside, waiting for certainty, are left wondering what happened. Let me show you this pattern 3 times, because once is coincidence, twice is a trend, 3 times is a law. Go back to 1932. The United States is in the depths of the Great Depression. Unemployment is at 25%. Banks have been collapsing for 3 years. The Dow Jones Industrial Average has fallen from 381 points in 1929 to just 41 points in July of 1932. That's an 89% collapse. People are terrified. Not the abstract kind of terrified we feel when we see our 401k drop 15%. Real, visceral, bone-deep fear. People lost everything. Businesses shuttered. Families lost their homes. In that environment, what would you do? Most people, and I mean the vast majority, did exactly what you'd expect. They held cash. They bought government bonds. They stayed as far away from stocks as they possibly could. But a small group of investors looked at those numbers and saw something different.
They saw that some of the greatest companies in American history, companies that had been building railroads, manufacturing automobiles, producing steel, were being sold for a fraction of their real value. Companies that fundamentally were still operating, still producing, still had assets, still had a future. And those investors, many of them not wealthy at all, just people with a few hundred or a few $1,000s, started buying. From 1932 to 1937, the Dow Jones rose from 41 points to 194 points. That's a gain of roughly 373% in 5 years. Think about what that means in real terms. A school teacher who put $1,000 into a diversified basket of stocks in 1932 would have had nearly $4,700 by 1937, in the middle of the Great Depression, when everyone else was too scared to move. Now, here's the thing I want you to understand about that story. It wasn't just the rich who did this. The historical record is full of middle-class Americans, store owners, factory workers, farmers, who recognized that they were living through a once-in-a-generation buying opportunity and acted accordingly. Many of them quietly built wealth that changed their families for generations. That is example number 1.
Fast forward to 2002 and 2003. The dot-com bubble has burst. The Nasdaq had crashed 78% from its peak. Trillions of dollars in market value had evaporated. Enron collapsed. WorldCom imploded. The 9/11 attacks had shaken confidence to its core. And then, just as people were starting to recover psychologically, the market kept dropping. By early 2003, fear was at a level that most analysts were saying the era of stock market wealth building was over. Some very serious, very credentialed economists were writing articles saying this. The headlines were brutal. Every financial magazine was running cover stories about the death of the bull market. And yet, if you had put $10,000 into an S&P 500 index fund in March of 2003, the absolute depths of the post-dot-com despair, by October of 2007, just 4.5 years later, you would have had approximately $19,500, nearly doubling your money while the people around you were still paralyzed by fear. But here's where it gets really interesting, because 2003 wasn't just about the stock market. Real estate was also beginning what would be one of the most dramatic runs in American housing history. A couple in Phoenix who bought a modest investment property for $180,000 in 2003 could sell it for $320,000 or more by 2006. That's a profit of $140,000 in 3 years on a single house. Meanwhile, a generation of regular, middle-class people were discovering for the first time that they could build serious wealth not through their salaries, but through their investments. And many of them became the very first millionaires in their families. The common thread between 1932 and 2003? Maximum fear followed by extraordinary opportunity. That's example number 2.
Now we get to Terry's moment. March 2009. The financial crisis has destroyed $11 trillion in household wealth in the United States alone. Lehman Brothers has collapsed. Bear Stearns is gone. The housing market has cratered. Unemployment is rising toward 10%. The S&P 500 has fallen 57% from its 2007 peak. Analysts, serious, experienced, well-paid analysts, are on television saying things like, "We may be looking at a lost decade." The level of fear in the market at that moment is almost impossible to overstate. The VIX, which is a measure of market volatility and fear, had hit levels not seen since the Great Depression. And here's what most people did. They pulled their money out of the market and waited. By the end of 2009, many of them still hadn't gone back in. They were waiting for certainty, waiting for the market to prove it had recovered, waiting for the fear to go away. But some people like Terry, didn't wait. From March 2009 to February 2020, just under 11 years, the S&P 500 went from roughly 666 points to over 3,380 points. That is a gain of just over 400%. $14,000 invested in March 2009 was worth approximately $70,000 to $110,000 by 2017, depending on where exactly you invested and how you managed it. We're now talking about the longest bull market in recorded American history, and it began, literally, factually, in the moment of maximum fear. People who invested $5,000 in 2009 didn't become fabulously wealthy, but people who invested $20,000, $30,000, $50,000, people who made a real commitment at that moment of fear, many of them crossed the $1 million threshold in net worth for the first time in their lives. 3 examples, 3 different eras, 3 different catalysts, one pattern. Fear peaks, prices collapse, opportunity opens. Those who act are rewarded. Those who wait miss it.
So here's the question you've been waiting for. What is happening right now that mirrors these historic moments? And I want to be very clear here because I'm not interested in giving you hype. I'm not trying to sell you anything. I'm going to give you the honest, professional assessment I would give to a close friend sitting across the table from me. What we're living through right now is a confluence, a meeting point of several powerful forces that, together, create conditions that I have not personally seen since 2009, possibly longer. Let me walk you through them. Force number 1, interest rates and their aftermath. Over the past few years, central banks around the world raised interest rates dramatically to fight inflation. This had a predictable effect. It crushed asset prices. Bond prices fell. Real estate markets slowed significantly. Growth stocks, particularly in technology, were hammered. Some high-growth companies lost 60, 70, even 80% of their value. This is the compression phase, the spring being wound tight. And here's what history shows us. When interest rates begin to fall, and all signs point toward that happening, compressed assets release violently, quickly, and the people who bought them at their compressed prices look like geniuses. Force number 2, artificial intelligence and the productivity revolution. Now, I know what you're thinking. Mike, is this just another tech bubble? Are you going to tell me to buy some speculative AI startup that's going to zero? No, that's not what I'm saying at all. What I'm saying is this. Every major technological revolution in history has been preceded by a period of chaos and uncertainty. The railroads in the 1800s, the electrification of the economy in the early 1900s, the internet in the 1990s and 2000s. And in each of those revolutions, there were 2 groups of people: the speculators who chased the hot new thing and often got burned, and the careful investors who identified the foundational infrastructure of the new era and bought it when everyone else was confused and scared. AI is not a fad. The productivity gains it is enabling are being measured by economists right now, and they are significant. The companies building and deploying this technology at scale are generating real revenue, real earnings, real cash flow. Force number 3, the wealth transfer. This is the one people don't talk about enough. Over the next 20 to 30 years, an estimated $84 trillion in wealth will be transferred from the baby boomer generation to their children and grandchildren. This is the largest transfer of wealth in human history. A portion of that money, a meaningful portion, will flow into investment markets, into real estate, into alternative assets, into the very things that are currently undervalued. When that wave hits, prices will rise, and those who own assets when that wave arrives will benefit enormously.
Here's the hard truth. I've just laid out a compelling case built on 25 years of professional experience and 3 clear historical precedents that we are sitting in a significant window of opportunity. And most people watching this will do nothing. Not because they're stupid, not because they don't understand, but because of a phenomenon that behavioral economists call loss aversion. Here's how it works. The human brain is wired to feel the pain of losing money approximately twice as intensely as it feels the pleasure of gaining the same amount. Losing $1,000 feels about as bad as gaining $2,000 feels good. This is evolutionary. It kept our ancestors alive by making them highly sensitive to risk. But in a financial context, it is absolutely catastrophic because it means that in moments of maximum fear, which are, as I've shown you, the moments of maximum opportunity, your brain is screaming at you to stop, to wait, to protect what you have. Your brain is actively working against your financial interests. The wealthy know this. The institutions know this. In fact, and this is something that rarely gets discussed openly, institutional investors depend on retail investors being frozen by fear because it's the fearful retail investor who sells at the bottom, and it's the institutional buyer who is waiting to buy what they sell. I want to say that again because it's important. When the average person panics and sells, someone is buying. That someone is almost always a wealthy institution, a sovereign wealth fund, a hedge fund, or a very experienced private investor who has seen this pattern before and is acting on it. They are buying your fear. The question is, do you want to be on the selling side of that transaction or the buying side?
All right, let's get practical, because none of this matters if I just leave you with theory. You came here for actionable information, and I'm going to give it to you. Step 1. Assess your actual position. Before you invest a single dollar, you need to understand where you are. What do you owe? What do you own? What is your monthly cash flow? How many months of expenses do you have in liquid savings? Rule of thumb, before you invest aggressively, you want at minimum 3 to 6 months of expenses in an account you can access without penalty. This is your buffer. This is what keeps you from being forced to sell at the wrong moment. Step 2. Understand your time horizon. The pattern I've described today, the fear-wealth inversion, works over a time horizon of 3 to 10 years. If you are going to need this money in 18 months, this strategy is not for you. The short-term noise of the market is unpredictable. The long-term trend in a growing economy is not. Terry didn't invest his $14,000 expecting to be rich in 6 months. He was patient, he held, he let time and compounding do the work. Step 3. Diversify intelligently. I am not telling you to bet everything on one sector, one stock, or one asset class. That is speculation. What I am describing is investment. A sensible approach for a regular person who is recognizing this window might include a core position in broad market index funds. You get exposure to the entire market's recovery without needing to pick winners. A secondary position in sectors that historically outperform in the early stages of a recovery, financials, industrials, certain technology segments, and, depending on your situation, some exposure to real estate, either directly or through REITs. Step 4. Automate and commit. The single most powerful thing that most regular people can do, and this is not glamorous, but it works, is to set up automatic monthly contributions to their investment accounts and simply not touch them. Not because it's the highest return strategy in theory, but because it removes the psychological element. You stop trying to time the market. You stop reading the scary headlines and making emotional decisions. You just invest, consistently, every month, and over time, the math works in your favor. Warren Buffett said it best: the stock market is a device for transferring money from the impatient to the patient. Be patient. Step 5. Educate yourself, but don't get paralyzed. There is a phenomenon I see constantly in the people who fail to take advantage of these windows. I call it analysis paralysis. They read everything, they watch every video, they attend every webinar, they build spreadsheets, and then they do nothing. Knowledge is only valuable when it leads to action. At some point, you have to decide that you've done enough homework and you're going to make a move. Not a reckless move, a calculated, diversified, long-term oriented move. Because here's the uncomfortable truth. Perfect information doesn't exist. You will never have 100% certainty. The people who built wealth from the crashes of 1932, 2003, and 2009 did not have certainty. They had conviction based on pattern recognition and historical evidence. That conviction is what you're building right now, watching this.
Let me bring this home. I started with Terry,
a gym teacher from Ohio who drove an old Camry and packed his lunch and quietly turned $14,000 into over $100,000 by recognizing a pattern that most people either didn't see or were too afraid to act on. Terry is not an exception. History is full of Terrys. There was a factory worker in Detroit who bought GM stock in 1933 and retired wealthy in 1970. There was a school teacher in Phoenix who bought a rental property in 2003 and paid for her children's college with the profits. There was a nurse in Atlanta who maxed out her Roth IRA every year from 2009 to 2019 and crossed $1 million in net worth at age 54, the first person in her family to do so. These are not fairy tales. These are the quiet, undramatic, powerful stories that happen in the background every time one of these windows opens. The windows don't announce themselves with fanfare. They open during periods of fear and uncertainty. They close when confidence returns and prices rise. And almost always, almost every single time, the people who look back and say, "I should have done something," are the ones who had the information, recognized the opportunity, and let fear stop them. The information is there. The historical record is clear. The pattern is established. The only variable left is you. What will you do with this window? I can't answer that for you. Nobody can. But I can tell you this, from 25 years of watching people navigate these moments, the ones who acted, even imperfectly, even with modest amounts, even with uncertainty in their hearts, those are the ones who came out the other side transformed. And the ones who waited for certainty, they're still waiting. This is Mike. I'll see you in the next one.